Hello, retail investors. It's Marcel, the Butcher of Wall Street. Let's take a quick peek at what we're looking at today. We're looking at old Yeller, once again, screaming about our terrible economy and pretending that everything is okay. Trade deficits, commercial real estate, central bank rate hikes. The United States is in for a really tough time, as is the rest of the global economy. If you take a look at this article just published today, U.S. trade deficit has surged 23% to a 6-month high as exports sink and imports jump. This is nothing new, ladies and gentlemen. But taking a look at this, the U.S. trade deficit has widened significantly in April as exports plunged and imports rose, putting downward pressure on U.S. economic growth, but indicating that consumer appetite for goods remains strong. People are desperate for goods, and they're not being made domestically anymore. We're also exporting much fewer items, as nearly nothing is made in America anymore, and our economy here in the United States is collapsing around us. This is what one would call stagflation. Inflation is still occurring, but the economy is very stagnant. These are interest-only loans as a share of new commercial mortgage-backed securities, CMBS, and they have increased to 88% in 2021, which in 2013 they were only at 51%. So what this means is that from 2013, only 51% of loans were interest-only payments. And now, as of 2021, that is 88% of all commercial mortgage-backed securities. That is an astronomical number. So interest-only loans as a share of the new CMBS issuances are coming up to nearly $1.5 trillion due over the next 3 years. We're looking at millions, not at billions, but trillions of dollars due in the next 3 years. $1.5 trillion. And Fitch Ratings has recently estimated that 35% of pooled securitized commercial mortgages that are due between April and December of this year will not be able to refinance based on their current interest rates and the property's incomes and values. So we're looking at malls, hotels, and offices facing huge default risks, and the situation is particularly dire for these office owners. Recently, lenders and borrowers, they had widespread belief that interest rates would stay low forever and that property values, which are already clearly in a bubble, would keep rising forever. That's obviously not the case. We have a $1.5 trillion bill coming due with property values, office space, hotels plunging like a rock. 83% of securitized office loans are in major trouble, according to CoStar's, a data company, Risk Analytics. And they will not be able to refinance. Recently, we saw a Hilton hotel in San Francisco, 1,921 rooms, was just abandoned. And the Park Hotel and Resorts also walked away from another 1,000 plus room hotel, Park 55. And Park Hotels and Resorts cited the debt burden in San Francisco and the two hotels and multiple factors that have made San Francisco very undesirable. Recently, just today, we had Janet Yellen, the Treasury Secretary and head of the plunge protection team, state that I think there will be issues with commercial real estate. Let's take a quick peek at this before we continue the stream. It's about 4 minutes long.
I wanted to ask you about the banking business, but as it relates to commercial real estate, there's a lot of worry, as you know so very well, about the state of commercial real estate, especially around office, and what that means to a lot of the regional banks, maybe not now, but come the end of this year, early next year, and the implications for that. Some people believe that there could be more bank failures. How concerned are you about that?
Well, I do think that there will be issues with respect to commercial real estate. Certainly the demand for office space, since we've seen such a big change in attitudes and behavior toward remote work, that has changed, and especially in an environment of higher interest rates, I think banks are broadly preparing for some restructuring, and especially in an environment of higher interest rates, I think banks are broadly preparing for some restructuring and difficulties going ahead. But I think certainly stress tests of the largest banks show that they have adequate capital to deal with it. And I know the supervisors will be looking closely at a wide range of banks to make sure that they're adequately prepared to deal with it. But my overall read is that the level of capital and liquidity in the banking system is strong, and that while there will be some pain associated with this, that banks should be able to handle the strain.
Would you be supportive of more consolidation in the banking business? I ask in part because on the other side of the administration, I think the Department of Justice and the FTC in particular have been very aggressive about trying to prevent transactions, not necessarily in the banking space, but given how outspoken you have been and the issues that may be unique in particular to the banking business.
Well, I see strength in a banking system that has a diverse set of financial institutions capable of satisfying different needs across our economy. And we do have a diverse banking system with strong community banks, regional banks.
Look at her eyes as she reads off her teleprompter.
Banks that are involved in global business. And I wouldn't want to see that threatened. But certainly in this environment, some banks are experiencing pressure on earnings, and there is a motivation to see some consolidation. And it wouldn't surprise me to see some of that going forward.
Madam Secretary, virtually every interview that we've done over the many years with you, we've always mentioned crypto. We're going to have Brian Armstrong from Coinbase on the program in just a little bit. Obviously, there's the lawsuit that the SEC has now brought against them and the separate lawsuit against Binance just in the past week. I'm curious where you stand now on crypto, because I think there was an evolution in your thinking in certain ways. Maybe it's changed. I don't know. What's your sense for the American public who's thinking about whether to invest in the world of crypto today?
Well, you know, we recently wrote, Treasury contributed a set of reports in response to the president's executive order to examine the risks inherent in crypto, and we identified a number of risks, some of which risk to consumers, investors. Our laws are already strong. The SEC, the CFTC, and other regulators have the ability and tools to protect consumers and investors, and I'm supportive, very supportive of seeing those agencies use the tools they have. I can't comment on the individual matters the SEC is looking at, but I think it's certainly appropriate that they do that. And then I see some holes in the system where additional regulation, I think, would be appropriate, and we would like to work with Congress to see additional legislation passed.
Yeah, indeed, there are holes in the system. You name it, there are holes in the system between rehypothecations and naked shorts. There are way too many synthetic shares out there. There's way too much leverage and a ridiculous amount of liquidity created by the liquidity fairy. Janet Yellen is clearly reading from her teleprompter and trying to convince people that everything is okay in the banking system and with American finances. In reality, what do you see here? Consumer loans and credit cards and other revolving loans in red, at all-time highs. Absolutely all-time highs. This is from the Bureau of Economic Analysis. And then you've got American savings at lows not seen since the 2008 Great Financial Crisis. Thirty-year mortgage payments are at the most unaffordable level that they have ever been. It is more expensive now to get a mortgage than ever in history. Huge shout out to everybody in the chat right now. I see you guys and girls. Thank you very much. Yvonne, appreciate you. You're too kind. And this is an absolute fact. The United States is unleashing a global dollar shortage as a weapon with the Fed, the SEC, and the Treasury all causing liquidity issues simultaneously. And it's absolutely true. They're raising rates at ridiculous levels. Russia is restricting energy. The SEC is cracking down on crypto. The SEC is raising big banks' minimum margin requirements. The United States Treasury is unleashing hundreds of billions of dollars worth, up to $1 trillion worth of Treasury bills, T-bills on the market. And that liquidity has to come from somewhere. Some people like to think that it's going to come from the reverse repo, but not all the money market and shadow banks, money market funds and shadow banks, they're not going to be the only ones that are buying those Treasury bills. So the money for that $1 trillion in issuances after this debt ceiling debacle is going to have to come from somewhere, and that's equities markets. This is the Bank of Canada overnight lending rate. The Bank of Canada has ended their pause with this unexpected rate hike to 4.75%, 475 basis points. This is the highest it has been in 22 years. This is the highest it's been since the 2000 the year 2000 dot-com bubble. 2 days ago, Australia shocked the global markets when they unexpectedly raised rates and hiked to 4.1%. That was an 11-year high, and they warned of more hikes to come. Today, Wednesday, June 7th, it was Canada's turn. And then we had the BOC hike their overnight rate to 4.75%, the highest since 2001. Absolutely astronomical. The Bank of Canada said overall excess demand in the economy looks to be more persistent than anticipated. Governing Council decided to increase their policy interest rate, reflecting our view that monetary policy was not sufficiently restrictive to bring supply and demand back into balance and return inflation sustainably to the 2% target. They also said that it will be evaluating whether the evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving the inflation target. And they added that it remains resolute in its commitment to restoring price stability for Canadians. Plain and simple, they're going to keep raising rates. Just like the United States will continue to raise rates at the next FOMC meeting here coming up in a few days. Former Philadelphia Fed President Charles Plosser said, "The banking turmoil really hasn't materialized. By pausing, the interpretation of the market is, quote, we're done." That's a very dangerous message to send. They're telling you literally they're not done, even though the market is pricing in that they may be. We are now looking forward to another rate hike, collapses in commercial mortgage-backed securities, and as a byproduct, residential mortgage-backed securities. These are net non-commercial E-mini S&P futures. Right now, there are more shorts in the stock market than there was in 2007 and 2008. This means that big money institutions are betting big time that this bull run in a bear market is just that, a fake bull run. I would be hard pressed to see this continue on for much longer. There are more shorts now than there was in 2011 during the debt ceiling crisis when the market tanked. 2015 and 16 when the market and the economy also had a nice downturn and has already eclipsed the lowest that we saw in 2007 and 2008. This is the inevitable consequence of central bank monetary policies, and it is entirely predictable. Okay? Deutsche Bank strategists say that corporate defaults will become, quote, more normal as we enter into a default cycle thanks to higher interest rates and a growing number of over-leveraged companies, banks, brokerages, and hedge funds, including family offices. Deutsche Bank said, our cycle indicators signal a default wave is imminent. The tightest Fed and ECB policy in 15 years is colliding with high leverage built upon stretched margins. And tactically, our U.S. credit cycle gauge is producing its highest non-pandemic warning signal to investors since before the great financial crisis. Okay? Deutsche Bank study projects defaults for U.S. high-yield debt will peak at around 9% in late 2024. For comparison, the high-yield debt default rate was a mere half of a percentage point in 2021 and 1.3% in 2022. So their study predicts that the recession that we've already entered will create a significant pain in world's credit markets, similar to the dot-com bust. And corporate leverage is extremely elevated right now. Global credit markets derive more of their revenue from manufacturing and the sale of physical goods than the real economy does, period. Going forward, corporations will likely lose pricing power on their sale of physical goods due to high inventory and a post-COVID demand shift from goods to services. But labor costs are likely to remain sticky, as is inflation, because of a shrinking working age population and a desire for consumers to recoup nearly 2 years of negative wage growth. Now we're also seeing Bank of America forecasting a wave of defaults. According to their analysis, defaults could rise to over $1 trillion if the United States economy enters into a full-blown recession. And at Moody's expects defaults on speculative grade corporate yields and debt will globally rise to 4.6% by the end of this year, up from March's predictions of 2.9%. We're already seeing a rise in corporate defaults, and more companies globally defaulted in the first quarter of 2023 than during any quarter since late 2020 at the peak of the government COVID shutdowns. Moody's also reported that 33 corporations defaulted on their debts in the first quarter, with 15 of those happening in March of 2023. So central banks globally blew up their gigantic debt bubble with nearly 2 decades of artificially low interest rates. Central banks pushed rates to zero in the wake of the Great Recession of 2008, and some banks, including the ECB and the Bank of Japan, took rates negative. Despite the efforts by the Federal Reserve to normalize rates in the 2010s, they never succeeded, and they already started cutting rates due to the shakiness in the economy before COVID. And during the pandemic, these assholes doubled down on their easy money policies. The whole point of monetary policy was to incentivize borrowing to stimulate the economy by printing money, and that's exactly what happened. Global debt hit a record $300 trillion at the end of 2022, according to data from S&P Global. That is 349% leverage against the global GDP and $37,500 of average debt for every person in the world. When you talk about Americans, for Americans alone, that's around $100,000 per person. Wow. And all of this was entirely predictable. The United States government is going to exacerbate the problem greatly. With the debt ceiling now out of the way, the United States Treasury will have to go on a borrowing binge in order to replenish the cash reserves that they spent while the government was up against the borrowing limit. Okay, Goldman Sachs tells us that their analysis states that the United States Treasury will need to sell $700 billion in T-bills within the next 6 to 8 weeks just to replenish the cash reserves spent while the government was up against the borrowing limit. On a net basis, the Treasury will have to sell more than $1 trillion in Treasury bills this year. The market may be able to absorb all of that paper through the reverse repurchase program, but it will almost certainly cause interest rates to rise even more as the sale drains liquidity out of the market, causing financial runs, bank runs, collapses in commercial mortgage-backed securities and residential mortgage-backed securities, but as a byproduct, the real estate market. This liquidity crunch will also spill over into the corporate bond market. The price of non-government debt instruments will have to fall as well in order to compete with Treasury bonds. That means the cost of borrowing will go up for everybody, making it harder for over-leveraged hedge funds, prime brokers, and family offices, and even regular companies to refinance. It's likely that Deutsche Bank and other mainstream analysts are greatly underestimating the extent of the default problem that is coming at us right now. This is going to be massive, ladies and gentlemen. Massive. And as I stated in our last video, Jerome Powell told us in 2011 exactly what would happen after the debt ceiling was raised, and the market went down astronomically after the raising of the debt ceiling. Not before it pumped, though, much like we're seeing the pump that's happening right now, which, in my opinion, is likely over. Check out this post from Dr. Marcel Metzler. Absolutely fantastic post here as we're seeing the SEC launches an attack on Binance and, as you may know, Coinbase as well. But as far as Binance, their U.S. assets are set to be frozen, and Dr. Metzler says it's time to withdraw funds as fast as you can. The financial world has witnessed a series of stunning events this year that have underscored the urgent need for ethical institutions to prioritize regulatory compliance and asset protection. Recent actions by the SEC against major crypto exchanges, Binance and Coinbase, have further underscored the importance of a safe and trustworthy financial environment. These developments, combined with concerns about institutions like Credit Suisse and Silicon Valley Bank, show that we are in the midst of a financial meltdown. In the midst of these challenges, I'm working tirelessly to create a stable and ethical financial system. For those of you that do not know, Dr. Marcel Metzler is the former director of Fitch Ratings Agency. He says, yesterday, the SEC filed suit against Binance and its CEO, Changpeng Zhao, accusing them of operating a web of deceit and unlawfully commingling funds. Similarly, Coinbase is accused of evading disclosure requirements and trading in unregistered securities. These regulatory actions are indicative of the SEC's increasingly aggressive campaign to assert its jurisdiction over the crypto industry and challenge the industry's argument that tokens are not securities. The outcomes of these cases will have far-reaching implications for the crypto market. He says the SEC even petitioned a federal judge in Washington to freeze all assets of Binance's U.S. subsidiary. The emergency order was filed late yesterday night, and would also force the repatriation of fiat currency and crypto assets deposited, held, traded, and or accumulated by customers on Binance.US crypto asset trading platform. Given these recent legal actions, people should immediately withdraw their funds from the platform as fast as they can before it's too late. And I think he's absolutely right. He continues to say, I and my team are currently working day and night on an alternative to the current financial system in which gold-backed security tokens, STOs, and tokenization of real assets will play a central role. And as you may or may not know, Dr. Marcel Metzler is currently working on an STO which can be exchanged for physical delivery of gold. That company is called Serious Gold Trading. I applaud Dr. Marcel Metzler for this, and hopefully we will be able to allow the purchase of Sirius Gold Trading's new STO on our new broker-dealer, which is upcoming in the near future, called Lit Exchange. You can check us out on litexchange.com if you'd like. Dr. Metzler making another fantastic post today that says, breaking news. The SEC charges classify 67 cryptocurrencies as securities, impacting over $100 billion worth of tokens. In a significant development for the crypto industry, the SEC has tightened its regulatory approach, classifying at least 67 cryptos as securities. This move is the result of the SEC's recent lawsuits against exchanges Binance and Coinbase, which he reported on. With these lawsuits, the SEC has expanded its classification of crypto, bringing the total number of tokens that are considered securities to an estimated 67. You're looking at BNB, Solana, Cardano, Polygon, and Cosmos, even Bitcoin Cash, but not including Bitcoin itself. The SEC's jurisdiction over these assets represents a paradigm shift in how digital tokens are viewed and regulated. He says, I anticipated this possibility a long time ago, and I'm watching the regulatory landscape closely. We are aware of the challenges and uncertainties that arise. However, we believe it underscores the importance of a compliant and ethical approach to crypto operations. That's why we at Sirius have chosen to launch our tokens as security tokens. By offering tokens classified as securities, we aim to provide our investors with an investment vehicle that aligns with regulatory requirements. Our security tokens will adhere to the regulatory framework governing traditional securities, ensuring compliance with disclosure and investor protection measures. Another company which is struggling with that is USDT, Tether. The SEC also said that to be considering a major crackdown on Tether, which could very well be the next in line after Binance and Coinbase. Now, if you may or may not know this, Tether, in many people's opinion, is the biggest Ponzi scheme ever. And they do not actually tell people what is actually backing Tether. They don't have any real proof of that. This could become the next, or actually the biggest, Ponzi scheme we have ever seen in the history of the world. So you guys could check out Dr. Marco Metzler on Twitter and LinkedIn. And keep an eye out for Sirius STO, SIRIUS. But here is the fake debt ceiling fight that we've been talking about this whole time. What nobody seems to be willing to say is that this problem falls squarely on the shoulders of the United States government, world governments, and central banks. They implemented policies that were intended to incentivize the accumulation of debt. It is another Ponzi scheme, the only Ponzi scheme that eclipses Tether. They created trillions of dollars out of thin air and showered the world with stimulus, unleashing a monstrous amount of inflation. And now they're trying to battle that dragon that they set loose by raising interest rates. This will inevitably pop the bubble, whether they like it or not. But as you may or may not be aware, they intend to do so. They intend to pop this bubble at your expense, the expense of your job, your house, your savings account, your credit cards, your well-being, period. Due to all the problems that we're seeing around the world with exchanges, we're currently working on launching Lit Exchange. And as we move forward, I could not say that I can't help myself but to say that a lot of brokerages, stock brokerages and crypto brokerages are in real bad shape right now. You're looking at them falling out of the sky because they're not following the government regulations that have been implemented. That's why we've been working on this for almost 2 years now, and very much look forward to bringing you Lit Exchange. So if you'd like to find out more, feel free to sign up. First 15,000 signups will be contacted to apply for beta testing and with information about our founders program. litexchange.com. That being said, I wish you peace and wealth. Thanks everybody for tuning in. Feel free to sign up and just drop your email. We'll never share, buy, sell. We'll never share, sell, or give away your email address or any personal info with anybody. Have a great day, everybody. If you have more questions, drop them down in the comments, and I'll try to make it a point to answer any questions you may have in regards to the current bubble that we're seeing. Thank you, everybody. Wish you peace and wealth. Oh, and before I go, yeah, we're going to be so fucking rich. Jerome Powell's going to need that fucking money printer. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Great. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
Yellen, give me the fucking money. Make sure you're properly hedged. Act accordingly. Get the goddamn money printer out.
Great. The bounty letter.
We're gonna be so fucking rich. Get the goddamn money printer out.